Hi candidates, welcome to another session of manifested online classes. So in this session, I want us to look on an illustration question regarding accounting for internal reconstruction or the capital reduction. In our previous session, we defined what is the internal reconstruction or capital reconstruction, or that is the capital reduction, and we looked on some of the conditions which the company should be able to fulfill for it to reduce now the share capital, and also we look on the accounting entries which are made during the internal reconstruction. And also we said that the main account which is prepared during internal reconstruction is an account which is called the capital reduction account. So in this session, I want us to look on an illustration question which is based on a past paper question, and the question is question number 1 of April 2023. So we go through the question, we see what we are told and equally what the examiner was requiring. So we are told Zura Limited, a private limited company which operates in the textile industry, has been in financial distress and has been reporting trading losses in the recent years. The company's latest statement of financial position as at 31st of July 2022 was as shown below. So we are given the statement of financial position of that company where we have the asset including non-current assets. Non-current assets include freehold property, plant and equipment, motor vehicles, fixed and fittings, goodwill. And then current asset include inventories, account receivables, and then we have the total asset. Equity, we have ordinary share capital, share premium, retained losses. And then we have the total equity. We have non-current liabilities, which include 15% loan notes. We have the current liabilities, which include account payables, bank overdraft, and then accrued loan notes interest. So then we have some additional information. We are told the board of directors of Zura Limited, which also comprises the main shareholders, have proposed, that is, a scheme of internal financial reconstruction with the effect from 1st August of 2022 at the following terms. Number 1, you are told the existing ordinary shares are to be reduced 2 shillings 2.5 per share. And then you're told the current shareholders are to fully subscribe for a new issue of ordinary shares of shillings 2.5 each at a par value on the basis of 4 shares, 4 new shares for every 5 shares which were held. So number 2, we are told the loan notes holders agreed to lower their interest rate to 12% per annum on condition that the accrued interest would be paid immediately. Number 3, we are told the outstanding account payables accepted 6.4 million ordinary shares of 2.5 each in full settlement of the amount due to them. 4, the company overdraft is to be repaid immediately. And number 5, we are told the share premium account is to be utilized for the purpose of capital reduction. And 6, the balances in the retained earnings into bracket losses and goodwill are to be written off. And then we are told in note number 7, the following assets are to be adjusted to their fair value as follows. A freehold property will be adjusted to a fair value of 49,050. Plant and equipment, its value will be adjusted to 95,005. Motor vehicle to a value of 53,60. Fixed and fittings to a value of 37,80. Inventory 10,050. Account receivables 29.25. And then you're told a reconstruction cost of shillings 4 million are expected to be incurred and paid. So what are we required? Number 1, you're required to make the journal entries to effect the scheme of internal reconstruction. And number 2, capital reduction account is at 31st of July 2022. And Part C, we are required to prepare the statement of financial position as at 1st of August 2022. That is immediately after the scheme of internal reconstruction. So this is basically a question for internal reconstruction, and we are required to do a number of things. Number 1, we make the journal entries to effect or to account for the proposed scheme of internal reconstruction. Roman 2 or Part B, we are required to prepare the capital reduction account. And finally, we are required to prepare now the statement of financial position of this company immediately after the scheme of reconstruction. So we start with part A of the question, whereby we are required to make the journal entries to effect or to account for the internal reconstruction. So these are journal entries. Journal entries, basically these are the same with accounting entries. These are the same with accounting entries. So these particular journal entries, or basically these accounting entries, will be made as far as the proposed scheme of internal reconstruction is concerned. So what we need to do, we need to go back to the terms now which are given for this proposed scheme of internal reconstruction, from where we have note number 1. In note number 1, we are told that the existing shares are to be reduced to shillings 2.5 per share. So if you go back to the statement of financial position which are given under paragraph 2, you'll be able to see that the ordinary shares of this company had a par value of 10, but you're told that par value will be reduced from 10 to 2.5. It basically means that part of the company's ordinary share capital will have to be written off. And therefore, what you need to do in such a case is to determine the amount of share capital to be written off, and basically you account for that. You account for what? For that. Remember these journal entries. When making the journal entries, generally we should have 3 columns in journal entries. The column for details, or the details column, the debit column here, the debit column here, and also the credit column here. And all our figures in this case will be in thousands of shillings. So what we are going to start with to account for, first of all, is the amount of share capital. Share capital written off, that what we are going to account for first. And we need to compute the amount of share capital which is to be written off. I think we can have our workings here, somewhere here. Workings. And the first working here is to compute amount of ordinary share capital. Ordinary share capital written off. In this case, the amount of share capital which will be written off per share will be 10 minus 2.5. The par value per share was 10, but we are told that will be reduced to what? To 2.5. So the difference, which is 7.5, is the amount to be written off. And then we need to multiply that with the number of ordinary shares issued by the company. So how do we get the number of ordinary shares issued by the company? We take the company's ordinary share capital from the statement of financial position. We divide that with the par value per share, which is 10. So this will give us 5,000 shares, and those are the shares now which were issued by the company. So therefore, what we need to do is basically to multiply that with the amount to be written off per share, which is 7.5 times 5,000. So that will give us an amount of 37,500. So how do we account for this particular share capital which is written off? Recall what we said in our previous session. So this particular amount of share capital which is written off, we said we debit it in the ordinary share capital, we credit it in the account called the capital reduction account. So we are going to debit the account called the ordinary share capital account with an amount of 37,500, and then we credit the capital reduction account. You also have to remember, when making these particular journal entries, or basically these accounting entries, always we start with the account to be debited followed by the account to be debited. You also have to give a narration. You have to give an explanation of what are you accounting for. In our case, we have said what we have accounted for there is the ordinary share capital which has been written off. Yes, so let's go back to point number 1. In point number 1, we are told in sentence number in paragraph 2, the current shareholders are to fully subscribe for a new issue of ordinary shares of shillings 2.5 each at par value on the basis of 4 shares for every 5 shares which are held. So in this case, we are told this company is to issue new shares to the existing shareholders. So what we need to do here is to compute the amount of money which will be received from the existing shareholders. So amount received from issue of new shares. issue of new shares, issue of new shares. So in this case, we are told the existing shareholders will subscribe for a new issue of shares on the basis of 4 shares for every what? For every 5 shares which are held. So basically we know that the shares which are currently held by the existing shareholders of that company is what you have computed there, 5,000. These are the shares currently held. So how many additional shares will be issued by the company here? So we cross multiply, then we divide 4 times 5,000, divide that with 5, and this will give us 4,000 shares. So these are the new shares to be issued by the company, and in this case we are told those shares will be issued at the new par value. Remember now the new par value per share will no longer be 10, but it will be 2.5. Because it was initially 10, it has been reduced to what? To 2.5. So therefore what we account for here is number 2 is amount received from new shares issued. New shares which have been issued. So how do we account for this particular amount? So automatically what we do is that we debit the bank account, because this is money received by the company, which will be 4,000 times 2.5. Automatically that should be 10,000, but we need to confirm that 2.5 times 4. Yes, so that will give us 10,000. So and then in this case, what do? We credit the account called the ordinary share capital account with the same amount of 10,000, because these shares were issued at what? At par value. So I think we are done with that particular point number 1. So let's move to point number 2, and we are told the roll notes holders agreed to lower their interest to 12% per annum on the condition that the accrued interest would be paid immediately. So in that case, we have 2 transactions. Number 1, the roll notes now which were issued by this company is per the statement of financial position given under paragraph 2 were 15% loan notes. So now we are told the holder of those particular loan notes have accepted to reduce, or have accepted a reduction in the rate of interest from 15% to what? To 12%. In other terms, what that means is that the 15% loan notes issued by the company will be exchanged with now 12% loan notes. We need to account for that. And number 2, we are told the accrued interest on those particular loan notes will have to be paid immediately. So therefore, what we need to do, we need to account for that. So we can talk of number 3 here. We can talk of a new 12% loan notes, which basically have been issued to replace the old 15% loan notes. So what we need to do is just to cancel the 15% loan notes, and because that account has a credit balance, so what we need to do, we need to debit that account. We debit 15% loan notes account with the value of those particular loan notes. So those loan notes have been cancelled. That's why we are debiting that account, and then now we account for the new 12% loan notes which have been issued to replace the old what? Loan notes. That's how we account for that. Then also from the information which are given there, we are told that the accrued what? Loan note interest, which is part of the current liabilities, will have to be paid immediately. Will have to be paid what? Immediately. So what we need to account for here is the payment of accrued loan notes interest. Accrued loan notes interest. We need to account for that. We need to account for that. So how do we account for this? So number 1, we debit that particular account. We debit the account called the accrued loan notes account, accrued loan notes interest account. So the amount of Raw notes interest which was not yet, or which was accrued, was 15. So we debit that account with 15. And then what we do is that we credit bank account. We credit bank account with the same amount of money, which is 1,500. So I think we are done now with the point number 2. Let's move to point number 3. And we are told the outstanding account payables accepted 6.4 million ordinary shares of shillings 2.5 each in full settlement of the amount due. So if you go to the statement of financial position, which you are given there specifically under current liabilities, you can see we are given the first item there being account payable. This is the amount of money which was owed to the suppliers. But you're told in note number 3 is that the suppliers will be paid that particular amount by being issued with the equity or ordinary shares of what? Of the company. So what we need to do is to account for that. So we can have that as our 5th accounting entry. So what we are accounting for here is what we refer as the conversion. We can just refer to that as conversion of the debt which was now owed to the suppliers to equity. So in this case, that account payable or the amount owed to the suppliers will have to be written off. Basically, or we need to cross off that account, and because that is a liability account, it has a credit balance. So how do we cross it off? We cross that particular account by debiting it with the amount of 17,500, and then we credit the ordinary share capital account with the shares which were issued to these suppliers. So as per note number 3, we are told the suppliers were issued with 6.4. Remember, all our figures are in thousands of shillings. So we take that figure in thousands of shillings, and these shares issued to them had a par value of what? Of 2.5. 2.5. So let's multiply the two figures. We see what that will give us. We have 6,400 times 2.5, which will give us 16,000. Which will give us 16,000. 16,000. But in this case, we are told that these particular shares issued to the creditors was to fully pay the amount owed to them of how much? 17.5 million. But you can see the ordinary shares issued to them had a par value of 2.5. Automatically, what that means is that these particular shares which were issued to the creditors were issued at a premium. And therefore, the difference between these two figures is a share premium. And therefore, that share premium will be credited in the share premium account, which is 1,500. Yes, so what we have accounted for there is basically the conversion of that debt into equity. So let's move to the other notes, which is note number 4, and we are told that the bank overdraft is to be repaid immediately. So this is the repayment of the bank overdraft. So once the a liability has been paid, then I've said you debit that liability account. So what you're going to do is to debit the bank overdraft account, because it's a liability, it has been paid. The bank overdraft in the, from the statement of financial position, specifically under current liabilities, was 3950, and then we credit bank account. We credit bank account with the same amount of money. Okay, we have forgotten to write the narration, but I think we can just write it here. So what we have accounted for here is the payment of bank overdraft. That is what we have accounted for there. Payment of bank overdraft. Let's move to the other point, number 5. We are told the share premium is to be utilized for the purpose of capital reduction. So once the share premium is utilized during the capital reduction, so what you do, you just cross the share premium. The share premium has a credit balance. To cross it off, you do what? You debit that account, and then you credit the capital reduction account. So what we are accounting for here is the share premium utilized during capital reduction. Utilized during capital reduction. I've said we debit the share premium account with the amount of the share premium. As per the statement of financial position, it was 10.5, and then we do what? We credit the capital reduction. the capital deduction account with the same amount of money. So we are done with that. Let's move to point number 6, and we are told that the balances in accumulated losses or the retained earnings account and the goodwill are to be written off. So I think we can just have a single accounting entry for that. That is accumulated losses, and goodwill written off. Let's just have a single accounting entry for that. So to write off goodwill, because goodwill is an asset, what you do, you credit the goodwill account and then you debit the capital deduction. To write off the accumulated losses, equally that account, the accumulated losses account has a debit balance. You credit that account and then you debit now the capital deduction. So therefore, here we are going to debit the capital reduction with the total amount which will be credited in the goodwill account. So the goodwill, if we go back to the statement of financial position, specifically where we have an current asset, the value of goodwill is 4375. I've said to write off goodwill, credit goodwill, and then you debit capital reduction. So, and then we also have the accumulated losses, which are to be written off. And I've said to write off the accumulated losses, we need equally to credit that account. We credit the accumulated losses account with an amount of 29,550, and then the total amount credited in those two accounts will be debited in the capital deduction account. So 4395, not 4395, 4375 plus 2955, or 550, that is. So that will give us a total of 33,925. So what we have accounted for here is the accumulated losses written off and also the goodwill written off. So we are done with point number 6. And then let's move to point number 7. In point number 7, we are told the following assets are to be adjusted to their fair value as follows. So what you're given in that particular information is how the assets were revalued. And therefore, what we need to do is to account for the revaluation of those particular assets. We know once a company revalues the asset, that revaluation can give rise to a revaluation gain or a revaluation loss. So what we need to do is to compare the fair values in note number 7 with the carrying amount or the net book value in the statement of financial position. In this case, we determine, was there a revaluation gain or loss? So let's start with the first asset here, which is a freehold property. A freehold property, as per note number 7, it was revalued to a value of 90, that is 49,050, and then we need to compare that with the carrying amount in the statement of financial position, which is a figure of 48,550. So therefore, this particular freehold property automatically was revalued upward because its net book value, its carrying amount was 48,550, but in this case, as per note number 7, it was revalued upward to a figure of 95,050. Not 95, but 49,050. So meaning that this one was revalued upward with 500, and this is a revaluation gain. So we do the same for the other asset, that is plant and equipment. Plant and equipment. Plant and equipment was revalued to a figure of 95,050. 95,005. What was its net book value or the carrying amount in the statement of financial position? It was 14,175. 14,175. 175. Basically, what that means that this particular asset, its value was revalued downward with an amount of 4670. So this is a decrease, and that is a revaluation, a revaluation loss. So then from there we have motor vehicles. We have motor vehicles. So motor vehicles were revalued to a figure of 5360, and then we compare that with the carrying amount. The carrying amount of the net book value from the statement of financial position, which is 7075. 7075, and equally in this case, the value of motor vehicle was revalued downward with the 1715, so equally, which is a revaluation loss. So we do the same for furniture and fittings. Furniture, that is fixture and fittings. The value for fixture or the fair value for fixture and fittings as per note number 7 was 3780. What about the carrying amount or the net book value from the statement of financial position? It was 4725. 4725. Equally, the value for this was reviewed downward with 495, equally, which is a revaluation loss. And then we have the other item, which is inventories. Inventories were revalued to a fair value of 10,050. And what was the carrying amount for the inventory in the statement of financial position? It was 11,825. 11,825, meaning that equally the value for inventory here was reviewed downward with the 1755, which is equally a revaluation loss. And finally, we have the account receivables. Account receivables as per note number 7 were revalued to a figure of 2925. 2925. What about the carrying amount? In the statement of financial position, it was 3175. 3175. So equally, this value was reviewed downward. It was reviewed downward. So let's compute that difference again. 2925 minus the carrying amount, which is 3175. 3175, and that will give us 250, which is equally a revaluation what? Loss. A revaluation loss. Yes. So basically we have that is the difference. Now how do we account for this particular revaluation gain or loss? Number one, because for freehold property it was revalued upward with this, so we need to increase the value for this. And basically to account for that, we debit this account. We debit the freehold property account, and then we credit the capital reduction account to increase the value for freehold property. But all these particular assets here, because they were revalued downward, so what we need to do is to reduce their value. So to do that, we debit which account? We debit the capital reduction account, and then we credit the specific asset account. The specific asset account. So therefore, let's first of all start by accounting for the revaluation gain on freehold property. Freehold property, which you have said is a figure of 500. Is a figure of 500. So we have said we account for that by debiting freehold property account with a figure of 500. We credit capital reduction account. Capital reduction account with the same figure. We have accounted for the gain, and then the other accounting entry, we account for these losses. So we can refer to that as the revaluation losses on assets, because we have a number of assets. A number of what? Assets. A number of assets. We have revaluation loss on various assets. So let's account for that. So we have number one, property and equipment. And I've said in terms of how we are going to account for this, we debit the capital reduction account, and then we credit the specific asset account. So the account to be debited is what we start with, and that is a capital reduction account. That account will be debited now with the total amount. We are going to get that total amount to be credited in the other accounts, and then we credit the first account, which is a plant and equipment, plant and equipment account with an amount of 4670. We have motor vehicles with a figure of 1715. We have fixture and fittings. Fixture and fittings, that account is to be credited with an amount of 945. And then we have inventories. Inventories to be credited with a figure of 1775. And finally, we have accounts. Account receivables. That account is to be credited with a figure of 250. Yes, 250. So then from there, what we need to do is basically to get now that total. So which is 4670 plus 1715 plus 945 plus 1775 plus 250. 250. That will give us a total of 9355. Maybe you can just confirm you have taken 4670, 1775. Okay, we have this 1775, we have 250, and then we have 945, we have 1715, and then we have the other figure of 4670. Okay, yes. So that's how we account for that particular devaluation losses. And devaluation losses arising from the devaluation of assets. So finally, what we need to do is to deal with the information given in note number 8. And in note number 8, we are told that the reconstruction cost of 4 million was incurred and also paid for. So how do we account for this particular reconstruction cost? This should be our journal entry number 11. So we have reconstruction cost which was paid. So to account for this, just quite simple. We debit the account called the capital reduction account. Capital reduction account with an amount of 4 million. Remember, all our figures here are in thousands of shillings, and because that amount was also paid, we credit now the bank account with that particular amount of what? Of 4,000. So basically, in our case, we are through with Roman 1 because we have been able to do what? To prepare those particular journal entries as required. So, and then from there, what we need to do next is we move to part B of that particular question, whereby the examiner was requiring we prepare now the capital reduction account. So the capital reduction account, we prepare it from what we have been able to do in part A, because we just need to check those particular journal entries which are affecting the capital reduction account, and we post them to that account. So what we are required to prepare here is the capital reduction account. Capital reduction account. So this is a ledger account having the debit and the credit side. So what we do, we basically go through these particular journal entries which we have done here, and we check which journal entry is affecting the capital reduction account, and we post such an entry here. So let's go through the first one. So is the capital reduction account affected? Yes. So the capital reduction should be credited, and the other entry will be in the ordinary share capital account. So we credit this account with an amount of 37,500. So and then the other one, this one do not affect the capital reduction, so we skip that. The same case with journal entry number 3 does not affect the capital reduction account. The same case with journal entry number 4. What about the accounting entry number 5? So is the capital reduction being affected? No. So what about the bank? This one? No. So but this one affects the capital reduction account. You can see the capital reduction account is supposed to be credited. The other entry will be in the account called the share premium. The share premium account with a figure of 10,500. Okay, what about this one? Yes, the capital reduction account is supposed to be debited with a total amount of 33.95. And the other entry, one of the entry will be in the goodwill account with a figure of 43.75. The other entry will be in the account called the accumulated losses account with a figure of 29.55. Okay, so let's move to the other journal entry number 9. Is it affecting the capital reduction? Yes, the capital reduction is supposed to be credited. The other entry is in freehold property. A freehold property account with an amount of 500. And then here, the capital reduction account is still affected, whereby that account will be debited with that amount. But we need to split this. One of the entry will be in the plant and equipment account. Plant and equipment account. Equipment account with an amount of 46.70. The other entry is in the account called motor vehicles account with a figure of 17.15. The other entry is in the account for fixture and fittings with an amount of 495. The other entry is in the inventories account with an amount of 17.75. The other entry is in the account receivables account with an amount of what? 250. So we are through with that. So let's come to the last journal entry here, whereby the capital reduction will be what? Will be debited with the reconstruction costs. So we can just refer to that as reconstruction cost, which was incurred and paid, an amount of what? 4 million. So we are done. What we just need to do finally is we balance this account. And this account here should either balance off or have a balance on this side, not on that side, but rather on this side, and that balance is known as a capital reserve. The capital what? Reserve balance. So let's balance our account here. So let's get the total first of all on the credit side. On the credit side, we have 37,500 plus 10,500 plus 500, and that will give us 48. That is the total on the credit, 48.5. What about the total on the debit? We have 43.75 plus 29.550 plus 46.70 plus 17.15 plus 9.45 plus 17.75 plus 250 plus 4,000. Yes, that is coming to the total on the debit is coming to 47,280. So mean that the amount which is more is the total on the credit. So that is 48,500. That's what we record there, 48,500. So we know the total on this side is coming to that, but the total on this side is not 48.5. It is this one. So the difference between the two values will be what? Will be 1220, and this 1220 is what we are referring to as capital reserve. This one, in preparing the statement of financial position of this company after reconstruction, it is taken there as a component of what? Equity. As a component of what? Equity. So we are done with the part B of that question. Let's move to part C. And in part C, what we are required to do is we prepare now the opening statement of financial position of this company. And basically, most of the marks they are free because like for the asset, we're given the value for all the asset and so on. So therefore, let's prepare the statement of financial position of this company as at 1st of August 2022. 1st of August 2022. So here we start by recording non-current assets. We start by recording non-current assets. So we just need to have a single column here. And also we have to remember all our figures are in thousands of shillings. So which non-current asset do we record here? What we do, we basically go back to the statement of financial position which is given, and basically we record now those particular assets, but we also have to remember most of those particular assets were revalued as per the information we have in note number 7. So, but some of them equally were written off. So the first asset as per the statement of financial position is the freehold property. Now, the value we are going to record here for the freehold property is the new value which are given in note number 7, which is 49,050, because we know freehold property was revalued to that value of 49,050. We go back to the statement of financial position. Below freehold property, we have plant and equipment. Plant and equipment, its new value is in note number 7, which is 95,05, 95,05, 95,05, and 95,05. And then back in the statement of financial position, we have motor vehicles. The new value for motor vehicles is in note number 7, which is 360. And then from there we have, back in our statement of financial position, below motor vehicles we have fixtures and fittings. The value for that, the new value for that is in note number 7, which is 3780. 3780. Then back in our statement of financial position, we know that goodwill was written off. So the goodwill will not appear in the statement of financial position of this company after the internal reconstruction because it was written off. I hope you can remember that. So then under the current assets, we record the current assets. The current assets. So for the current asset, these will include inventories. So the inventories were revalued as per note number 1, and the new value for inventories is 10,050. 10,050 is 10,050. And then still back in our statement of financial position, we have account receivables. The new value for that is given in note number 7, which is 2925. 2925. Yes, before we get the total asset here, there is something we need to prepare. We need to prepare the bank account, and we get the new balance in that account because we know this company issued some new shares to the existing shareholders. It was able to do what? To raise some cash. So therefore, we have to prepare that account. Bank account, let's prepare that particular account here. So that we can be able to determine the new balance in the bank account. So we can do away with some of these journal entries. So we prepare the bank account. So for the bank account, we need to check the journal entries which are affecting bank. Automatically, the ones which have done away with there, they were not affecting the bank. So this is not affecting the bank. This one is affecting the bank, whereby the bank account is supposed to be debited with the amount of money which was received. So the other entry is in ordinary share capital account with an amount of 10,000. And then this one is not affecting the bank. This is affecting the bank, whereby we have accrued loan note interest, which was paid, a figure of what? Of 15, that is affecting bank. This is not affecting bank. This is affecting bank, whereby we have a payment of bank overdraft, bank overdraft, a figure of 3950. So what I've done away with here was not affecting bank. The same case with the journal entry number 10, but number 11 we have that reconstruction cost which was paid, so which is supposed to be credited in this account an amount of 4,000. And then from there what we do, we balance our account, we determine how much amount was in the bank account. Was there still a bank overdraft, or there was some cash available in the bank? So we need to get the total on the credit. We have 15 plus 3950, 3950 plus 4,000, which will give us 9450 minus what we have on the debit, 10,000. So that will give us a balance here, carry down of 550. 550 is basically the money in the bank. The money in the bank, you can see this will be a positive balance. So meaning that in the bank there was some amount. We have bank balance of 550. Yes, and with that we can get now the total assets. Total asset, we need to add current and non-current asset. So we can start with what we have here, 49,050 plus 9505 plus 5360 plus 3780 plus 1005 or 050, 10,050 plus 2925 plus 550. So that will give us a total asset of 81,220. Yes. So then from there we record the financials, which include equity and liabilities. And still here we need to go back to the statement of financial position. We see which items of equity we have. The first one is ordinary share capital, but we need to compute the new balance in this particular account, because as per the statement of financial position we are given there, ordinary share capital initially was 50,000, but from what you're given here, we know share capital is to reduce with that particular amount. So we need to deduct 3750 because the capital will be reduced with that amount. But we also need to add the new shares which were issued. So to that we add 10,000. This will not affect the ordinary share capital, the same case with that. And then we have these shares now which were issued to pay the creditors. We need to add that here, 16,000. Yes, so this will not affect the ordinary share capital. And basically what we had here in note number 7 about the share premium. And then, yes, so I don't think we have anything else which will be affecting the share capital. So what we need to do is to get the new balance in that particular account. So we have 50,000 minus 37,500 plus this will be 26,000, which will give us a new balance of 38,500. After the construction, the new share capital of the company will be what? Will be 38,500. Then, in the statement of financial position, the share premium which we have there, we need to recall it was utilized during the capital reduction. That will not appear here. But these particular shares which were issued to the creditors to pay their debt, they were issued at a premium. So we are going to have a new share premium. A new share premium of 1,500. And then below that we have in the statement of financial position below the share premium, we have accumulated losses. That amount equal was written off. It will not appear here. Yes, but we also have to recall from this particular account which I have prepared, we have this capital reduction which we said will be taken to the statement of financial position as a component of equity. So we have a capital reserve, a reserve of how much? Of 1220. So I think we can now get the total equity. let's get the total equity. The total equity will be 38,500 plus 1,500 plus 1,220. That will give us 41,220. 41,220. Yes. And then next we record liabilities. We start with the non-current liabilities. Non-current liability. In our case there, we only have one non-current liability, 15% loan notes. But you have to recall what you were told in note number 2, that those 15% loan notes are to be converted to a 12% loan note. So therefore, those particular 15% loan notes will no longer exist, but we are going to have a new 12% loan notes having the same value of 40,000. Having the same value of 40,000. And then from there we have the current liabilities. Now the current liabilities, we have two items of current liabilities. The two items of current liabilities, one is the account payables. This is the amount of money which was owed to the suppliers. We know that amount was paid by the company in terms of issuing the ordinary shares. So that amount will not appear there. That amount was paid or was converted into equity. Also, we have the bank overdraft. We know the bank overdraft was paid. The bank overdraft will not appear here. And equally, the accrued loan note interest, we know that was equally paid by the company here. So, meaning that all those particular current liabilities, none of them will appear here. Yes. And then from there, what we do, we get the total equity and liabilities. Total equity and liabilities, which will be this plus this, and that will give us 81,220. 81,220, and basically that should be the same with what we have up there as the total what? The total assets. So basically that is it, that what was required as far as that particular question is concerned. And before we wind up, I want to give an assignment. We have two questions. The question for November 2022, which is question number 4B, and also May 2019, question 3B. So let me note down those particular questions here. This is the assignment. This is your assignment. The first question is question number 4B, November 2020. And also we have another question for May 2019, which is question number 3B. So what you need to do is to ensure that you attempt those two questions, and equally, once you attempt them, I usually encourage my student to acquire this particular division partner by Manifested Publishers. And all the solutions for these particular questions are at the end of that book. The other good thing with this particular division partner is that it is updated up to the latest sitting. So therefore, equally acquire this. It will help you in course of your revision. So that brings us to the end of that session. Bye for now. See you in the next session.